Disclaimer.
The media told you JP Morgan's $9 and $20 million fine was a punishment. They lied. It was a service fee to keep a multi-billion-dollar manipulation machine running, but their playbook just leaked. Today, I'm showing you the exact spoofing fingerprints we found in this week's silver crash and why the banks are terrified that this time they've run out of physical metal to cover their tracks. The curtain is being pulled back, and what's behind it will change how you trade silver forever. What if I told you that America's largest bank just executed the most profitable trade in financial history, and they did it by first getting caught committing crimes? September the 29th, 2020. JP Morgan Chase writes a check for $920 million to the Commodity Futures Trading Commission. At the time, financial media called it the largest penalty ever imposed for market manipulation. But here's what they didn't tell you. That fine was not the end of the story. It was proof that the setup was already complete. Think about what $920 million represents for a bank pulling in $120 billion in annual revenue. That's less than 3 days of income. You don't pay pocket change like that unless you've already secured something far more valuable. The CFTC documents revealed that between 2008 and 2016, JP Morgan traders placed thousands of fake sell orders in precious metals markets, a practice called spoofing that triggers panic selling and drives prices artificially lower. The regulators called it market manipulation. The Department of Justice went further and called it what it actually was: criminal racketeering. Two of JP Morgan's precious metals traders, Michael Nowak and Greg Smith, were sentenced to federal prison in 2023. These weren't rogue employees making unauthorized trades. Court documents show they operated with supervisor approval, executing a coordinated strategy over 8 years. When federal prosecutors bring RICO charges against bank traders and win convictions, you're not looking at paperwork errors or aggressive trading. You're looking at organized crime in suits. But here's where this gets interesting for you and your financial future. While JP Morgan was placing those fake sell orders and driving silver prices down, something else was happening in their physical vaults. They were buying. Every time those spoofed orders triggered panic and pushed prices lower, JP Morgan's other desk was accumulating actual physical silver at artificially depressed prices. According to independent analysis of COMEX vault data and delivery patterns, the bank has accumulated what's now estimated to be approximately 750 million ounces of physical silver. That's the largest privately held silver stockpile in recorded history. Let me put that number in perspective for you. Take every silver eagle coin the U.S. Mint has produced in the last decade and add them together. JP Morgan's reported position is roughly 15 times that amount. Now think about your own investments for a moment. When you buy silver coins or bars, you're purchasing ounces. When institutions trade silver, they deal in thousands of ounces. JP Morgan allegedly accumulated 750 million ounces. That's not an investment position. That's a monopoly. And here's what should grab your attention right now. Silver just crashed from a record high of $121 per ounce on January 29th, 2026, down to around $77 where it sits today in early February. Financial media called it profit-taking and a technical correction. But look at what's happening beneath that price movement. The COMEX, which is the world's largest silver exchange and the place where global silver prices are set, has seen its registered inventory collapse. Back in 2020, when JP Morgan paid that fine, COMEX vaults held 346 million ounces of silver available for delivery. Today, according to the latest COMEX warehouse stocks report, that number has fallen to just 82 million ounces. Do that math with me. JP Morgan's alleged hoard of 750 million ounces is now more than 9 times larger than all the deliverable silver sitting in COMEX registered vaults. That means one bank potentially controls 9 times more physical silver than the entire inventory backing the world's primary silver price discovery mechanism. When you check silver prices on your investment app or your coin dealer's website, you're seeing a number generated by trading on the COMEX. But what happens when the entity with the largest physical stockpile in history also spent 8 years criminally manipulating that same market? Here's a scenario to consider. You're planning a vacation and you check flight prices online. The website shows seats available at $300, but when you try to book, you discover there are actually only 5 seats left on the plane while 200 people are trying to buy them. That $300 price was never real because it didn't reflect true supply and demand. Now replace that airplane with the global silver market. Replace those 5 seats with 82 million ounces, and replace those 200 buyers with industrial manufacturers, solar panel companies, electronics makers, and investment funds, all competing for physical metal. What do you think happens to the price when people figure out the published number does not match physical reality? The elegance of what JP Morgan allegedly did is almost impressive if it weren't so brazen. Step 1, manipulate prices down for 8 years while regulators looked the other way. Step 2, Accumulate a massive physical position at those artificially low prices. Step 3. Get caught and pay a fine that represents a rounding error compared to the profits locked in. Step 4. Wait for the inevitable supply shortage that your own accumulation helped create. Step 5. Watch as prices rise on the mountain of metal you've already secured while everyone else scrambles for scraps. According to the CFTC's own findings, JP Morgan placed and canceled orders with no intention of execution more than 50,000 times across precious metals markets. That's not occasional aggressive trading. That's a systematic program running for nearly a decade. And while those spoofed orders were pushing prices down, triggering stop losses, and shaking out smaller investors, the physical accumulation desk was quietly building what would become the most concentrated commodity position in modern financial history. Think about the timing of that $920 million fine. September 2020, right in the middle of COVID-driven supply chain disruptions, unprecedented monetary stimulus, and the beginning of what would become a massive commodity supercycle. JP Morgan settled right before silver began its climb from 24 in March 2020 toward levels not seen in decades. They closed the book on their manipulation charges just as the manipulation was about to pay off spectacularly. You've probably heard that the big banks always win. You've probably felt frustrated watching financial institutions get fined for wrongdoing but never face real consequences. This is how they win. They don't just break rules and pay penalties. They break rules strategically, take the hit when it comes, and walk away with positions so valuable that the fines become trivial expenses. The $920 million wasn't a deterrent. Looking at where silver prices have gone and where they're heading, that fine was the best investment JP Morgan ever made in legitimizing their accumulation. And here's what matters most for your financial situation right now. While mainstream financial media treats this as old news from 2020, the real story is unfolding today in February 2026. That massive JP Morgan position is sitting on the market like a coiled spring. Those COMEX registered inventories keep falling while industrial demand keeps rising. And you, as someone paying attention to these patterns, have the chance to understand what the banks figured out years ago before they spent 8 years rigging the market to position themselves. The question you should be asking isn't whether JP Morgan manipulated silver markets. They admitted it. They paid the fine. Their traders went to prison. The question you should be asking is, why would they accumulate 750 million ounces of something unless they knew exactly where the price was heading next? That's what we're going to uncover together, and what you discover might change how you think about your own financial positioning in the months ahead. Now, let me show you the evidence that proves this isn't speculation or conspiracy theory, but a documented transfer of wealth happening in real time. Between June and October 2025, something extraordinary occurred in the COMEX futures positioning data that the Commodity Futures Trading Commission publishes weekly. JP Morgan's trading desk, which had maintained a massive short position in silver futures for years, closed approximately 200 million ounces worth of paper short contracts. But they didn't just exit the trade. According to the disaggregated commitments of traders reports, they flipped completely to the long side. Think about what that means for a moment. For years, JP Morgan was betting against silver prices rising, holding short positions that would profit if silver fell. Then, suddenly, in a 4-month window, they reversed course entirely and positioned themselves to profit from rising prices. That's not a subtle adjustment to a trading strategy. That's a complete 180-degree turn that costs significant money to execute, because you have to buy back all those shorts, often at a loss, before you can flip long. Banks don't throw away millions in losses on position reversals unless they see something massive coming that makes those losses look trivial. The timing of that reversal should make your antenna go up. October 2025 was exactly when industrial users started reporting serious difficulties sourcing physical silver. The U.S. Mint announced in November 2025 that American Eagle silver coin production would be constrained going into 2026 due to blank shortages. When the U.S. Mint, which has priority access to domestic silver production, starts telling the American public they can't get enough metal to make coins, that's not a minor supply hiccup. That's a red flag that physical availability has fundamentally shifted. Then January 1st, 2026 arrived, and China implemented export restrictions that changed the global silver market overnight. According to the China Non-Ferrous Metals Industry Association, the new regulations cut refined silver exports by approximately 121 million ounces annually, representing 60 to 70% of China's previous export volumes. Let me break down why this matters so much. China isn't just another silver producer. They're the world's third largest mine producer, and they've been the primary refiner, supplying both Asian and Western markets with investment-grade silver bars. When 121 million ounces suddenly gets removed from global trade flows, that's nearly 15% of total annual mine production vanishing from available supply. You probably noticed silver spiked to that record 121 per ounce on January 29th, right after these restrictions took full effect. Financial media called it speculative excess and said the correction back to $77 was healthy profit-taking. But look at what happened in the physical market during that price spike and subsequent crash. The COMEX warehouse data from January 2026 tells a completely different story than what you saw on price charts. Between January 20th and January 27th, according to the CME Group's daily warehouse stocks reports, registered silver inventory saw withdrawals of 33.45 million ounces in just 7 trading days. That's 26% of the total registered inventory leaving the vaults in 1 week. Registered inventory is the category that's available for delivery against futures contracts, meaning this is the metal that's supposed to back the paper trading that sets global prices. When a quarter of that inventory disappears in 7 days during a price spike, what you're witnessing isn't normal profit-taking. You're watching a delivery squeeze in slow motion. And here's what really matters for anyone trading or investing in silver right now. Those withdrawals didn't stop the price from crashing back down. Think about that carefully. Physical metal is pouring out of the exchange vaults at record rates. Industrial users are scrambling to secure supply. China has cut off 121 million ounces from global trade. And yet the paper price crashed 36%, from 121 to 77 in just over a week. Does that price action match the physical fundamentals you just saw? Here's where it gets even more interesting for sophisticated investors watching these markets closely. While COMEX prices crashed, physical silver premiums in markets across Asia and the Middle East exploded to levels we've never seen before. According to dealer reports from Dubai and Tokyo in late January and early February 2026, 1 kilogram silver bars were trading at premiums of 50 to 80% above the COMEX spot price. That means when your screen showed silver at $77, actual physical buyers in those markets were paying anywhere from $115 to $138 to secure real metal for immediate delivery. When physical markets decouple from paper markets by 50 to 80%, you're not looking at temporary volatility or regional supply issues. You're looking at 2 different markets pricing 2 different assets. One market is pricing digital contracts that promise future delivery. The other market is pricing actual physical metal that's becoming increasingly difficult to source. And which market do you think reflects real supply and demand? The futures contracts that can be created with a few keystrokes, or the physical bars that industrial manufacturers need for production lines that can't run without silver? Let's talk about the structural deficit that makes this situation inevitable rather than temporary. According to data from the Silver Institute's World Silver Survey and independent analysis from Metals Focus, the cumulative supply deficit from 2021 through 2025 totals approximately 820 million ounces. That number represents nearly 1 full year of global mine production. Think about what a cumulative deficit means. It's not that supply was tight for a few months. It's that for 5 consecutive years, the world consumed more silver than mines produced, drawing down inventories year after year to meet demand. And that deficit is accelerating, not improving. Industrial demand for silver in 2025, according to the Silver Institute, reached approximately 700 million ounces. Solar panel manufacturers alone consumed roughly 200 million ounces as global solar installation capacity surged. Electric vehicle production took another 90 million ounces for battery management systems, charging infrastructure, and vehicle electronics. The AI infrastructure build-out that every major tech company is racing to deploy requires massive amounts of silver for high-performance servers, data centers, and advanced chip packaging. Each new data center being built to handle AI workloads uses thousands of ounces of silver in electrical contacts, circuit boards, and thermal management systems. Now compare that 700 million ounce industrial demand to global mine production. According to the U.S. Geological Survey and industry reports, total silver mine production in 2025 was approximately 835 million ounces. On the surface, that looks like supply exceeds industrial demand by 135 million ounces. But here's the critical detail that most analysts miss. 75 to 80% of silver mine production is actually a byproduct of mining other metals, primarily copper, lead, and zinc. That means the vast majority of silver supply is completely inelastic. Let me explain what inelastic supply means for your investment strategy. If silver prices double, copper miners don't suddenly produce more silver. They produce the same amount of silver they were already producing as a byproduct of copper operations. Primary silver mines, which represent only 20 to 25% of production, can potentially increase output in response to higher prices. But that takes years of development, permitting, and capital investment. In the short to medium term, the 835 million ounces of annual production is essentially fixed regardless of price. So when industrial demand is consuming 700 million ounces, investment demand adds another 200 to 250 million ounces, and supply is capped at 835 million ounces. You've got a structural deficit that can only be resolved by either dramatically higher prices rationing demand or by drawing down existing inventories. And we've already seen that for 5 years running. The market has chosen to draw down inventories. But now look at where those inventories stand. COMEX registered inventories collapsed from 346 million ounces in 2020 to just 82 million ounces today in February 2026. The London Bullion Market Association vaults, which serve as the primary storage for European institutional silver, saw reported holdings decline from approximately 1.1 billion ounces in 2021 to an estimated 780 million ounces by the end of 2025, according to trade sources. The Shanghai Futures Exchange reported silver inventories of only 4.2 million ounces as of early February 2026, down from over 15 million ounces a year ago. Add up all the major silver exchanges and vaulting systems globally, and you're looking at total visible inventories that have been cut nearly in half over the past 4 years, while that cumulative 820 million ounce deficit was being drawn down. The inventory that used to buffer supply and demand imbalances is simply disappearing, and it's disappearing into permanent industrial consumption that doesn't return that silver to the market. When silver goes into a solar panel or an EV battery or a semiconductor chip, it's not coming back. That's silver permanently removed from above ground stocks. Now overlay JP Morgan's position on top of these fundamentals. If the bank truly holds 750 million ounces as vault data and delivery patterns suggest, they're sitting on nearly 90% of 1 year's total global mine production. They own more silver than all the visible inventories on the COMEX. They potentially own more silver than many countries' strategic reserves. And they acquired this position during 8 years when they were actively manipulating prices downward through spoofing, ensuring they bought at artificially depressed levels. The evidence in front of us shows a market where physical inventories are collapsing, where industrial demand is structurally exceeding mine supply, where the world's largest silver exporter just cut off 15% of global supply, and where the bank that criminally manipulated this market for 8 years just reversed from short to long, right before the supply crisis became undeniable. That's not a collection of coincidences. That's a coordinated positioning ahead of what they clearly saw coming. For those of you who trade silver derivatives or hold physical metal, understanding this setup is critical because we're approaching the point where the paper market's ability to set prices may simply break down. When physical premiums run 50 to 80% above futures prices, when registered inventories drop 26% in a single week, when major industrial users are securing multi-year supply contracts at premiums to lock in availability, the traditional price discovery mechanism is failing. And when that mechanism fails completely, the reset to physical-based pricing is going to be violent and swift. The manipulation case that resulted in JP Morgan's $920 million fine gave us the smoking gun that proved intentional price suppression. The positioning data from 2025 gave us the evidence that the manipulators reversed course and went long. The inventory data from early 2026 gave us proof that the physical market is in crisis. And the premium dislocations we're seeing right now in Asia and the Middle East are showing us that the paper price is increasingly disconnected from physical reality. Everything is in place. The question is simply how much longer the paper markets can maintain the illusion before physical delivery demands force a reckoning. Now let me show you the exact mathematical calculation that reveals why the system is about to break and why the banks are desperately hoping you don't understand what's coming before it arrives. Pull up the COMEX March 2026 silver futures contract data, and you'll see something that should immediately concern anyone involved in paper silver markets. According to the CME Group's open interest reports as of early February 2026, the March contract shows approximately 127 million ounces in total open interest. That represents traders holding positions that could theoretically demand physical delivery when the contract reaches first notice day. Now remember what we established about registered COMEX inventory. 82 million ounces as of the latest warehouse stocks report. Take a moment to process that ratio. There are 127 million ounces of contractual claims against 82 million ounces of registered metal available for delivery. That's 155% of available inventory in open positions for a single contract month. Under normal market conditions, only about 3 to 5% of open interest typically stands for delivery because most traders are speculating on price movements and roll their positions forward or cash settle. But these aren't normal market conditions. Industrial users who actually need physical silver for manufacturing operations do not have the luxury of cash settling or rolling contracts forward indefinitely. If you're a solar panel manufacturer with production lines that require 50,000 ounces of silver per month, you can't just take a cash payment instead and hope to find metal elsewhere when China has cut off exports and global inventories are collapsing. You stand for delivery. You demand the physical metal your contract legally entitles you to receive. And according to industry sources, industrial users typically represent 25 to 30% of open interest in the front month contract. Let's do that math together. If 25% of that 127 million ounce open interest demands physical delivery, that's 31.75 million ounces. If 30% demands delivery, that's 38.1 million ounces. Remember what happened during that 1 week period in late January? The COMEX saw 33.45 million ounces withdrawn in 7 days, and that was during a price crash when delivery pressure should theoretically decrease. Now imagine what happens when the March contract reaches first notice day on February 27th, 2026, and industrial users who have watched inventories collapse all year decide they can't risk not having physical metal. You're looking at delivery demands of 32 to 38 million ounces, hitting a registered inventory of 82 million ounces that already saw a quarter of its holdings disappear in 1 week just a few days ago. If even half of that metal leaves the vaults in response to March deliveries, COMEX registered inventory would drop below 50 million ounces. At that point, the April and May contracts would be staring at inventory levels that simply cannot support the existing open interest structure. The exchange would face a choice: either force cash settlement, which would destroy confidence in the COMEX as a physical delivery mechanism, or allow delivery demands to completely drain the vaults, which would achieve the same result. This is what a delivery squeeze looks like before it becomes obvious to the general public. It's not a single day where the exchange suddenly runs out of metal and prices gap up 50% at the open. It's a steady grind where inventory bleeds lower month after month, where premiums for physical metal gradually decouple from paper prices, where industrial users quietly lock in multi-year supply agreements at premiums because they can see the available pool shrinking. And then 1 month, probably March or April based on current trajectories, the delivery demands exceed the exchange's ability to meet them, and the paper price suddenly has to reconcile with physical reality. Now let's talk about what this means in terms of actual dollar values and why JP Morgan's timing was so precise. Bank of America's Commodities Research Desk published a report in December 2025, projecting silver could reach 309 per ounce by the end of 2026. Before you dismiss that as Wall Street hyperbole, understand what that target is actually based on. It's not technical analysis or momentum projections. According to their methodology, the price target reflects the level needed to significantly ration industrial demand and incentivize enough recycling to balance the structural deficit we've been running. At $77 per ounce, where silver sits today in early February 2026, industrial users are still consuming silver at near maximum rates because the metal remains economically viable for their applications. Solar panel manufacturers, EV producers, and electronics companies can absorb $77 silver in their cost structures without significantly reducing consumption. But at $200 per ounce, some marginal applications become economically unviable and demand starts getting rationed. At $300 per ounce, demand destruction becomes significant enough and recycling becomes profitable enough that supply and demand might finally balance without continuing to drain inventories. Now apply Bank of America's $309 target to JP Morgan's alleged 750 million ounce position. Multiple independent analyses of COMEX vault data, delivery patterns, and the bank's historical positioning suggest their average cost basis on this accumulated silver is approximately $20 per ounce. That makes sense given the time frame of their accumulation from 2008 through 2018, when they were actively suppressing prices through spoofing while their physical desk was buying. Silver averaged $18 to $25 during much of that period, so a $20 average cost basis aligns with systematic accumulation during the manipulation years. Let me walk you through the profit calculation on this position at various price points, and you'll understand why paying $9 and $20 million in fines was the best investment JP Morgan ever made. At today's price of $77 per ounce, JP Morgan's unrealized gain on 750 million ounces is approximately $42,075 billion. That's the difference between $77 and their $20 cost basis, multiplied across 750 million ounces. They've already made 46 times their fine amount at current prices. Every single dollar that silver rises from here adds another $750 million to their position value. A $10 move in silver equals $7.5 billion in additional profit for JP Morgan. Now take that math to Bank of America's $309 target. At $309 per ounce, JP Morgan's profit on this position would be $216.75 billion. That's the difference between $309 and $20 times 750 million ounces. Their $920 million fine represents 0.42% of that potential profit, less than half of 1%. Think about that ratio for a moment. You pay a penalty that equals less than 0.5% of the profit you're positioning to make, and in exchange, You get to keep the entire position you built through years of criminal market manipulation. That's not punishment. That's the cost of doing business when you're too big to actually face consequences. But here's what matters most for you and anyone else who recognized this setup and positioned accordingly. The wealth transfer isn't going from JP Morgan to nowhere. It's going from the entities that were on the wrong side of the trade to the entities that positioned correctly. For 8 years, while JP Morgan was manipulating prices down and accumulating physical metal, there were investors buying paper silver derivatives. There were mining companies hedging production at suppressed prices. There were industrial users who didn't secure long-term supply agreements because the paper market made silver look abundant and cheap. Those entities are now facing a market where physical metal is scarce, where delivery is uncertain, where premiums have exploded, and where prices need to rise dramatically just to ration demand down to available supply. The manufacturers who didn't lock in multi-year contracts at 25 silver are now scrambling to secure supply at 77 and might be paying $150 or $200 within months. The hedge funds that were short silver alongside JP Morgan before 2025 but didn't reverse when the bank did are watching losses mount. The pension funds and institutional investors who allocated to paper silver ETFs instead of physical metal are discovering their shares might not represent actual metal they can take delivery of in a squeeze. But retail investors, small institutional buyers, and anyone else who accumulated physical silver over the past several years while the banks were manipulating prices, you're sitting on the same side of the trade as JP Morgan. You bought physical metal when it was artificially cheap. You own ounces that industrial users desperately need and can't source elsewhere now that China has restricted exports and COMEX inventories have collapsed. You positioned yourself in the physical market while the paper market was still setting prices, which means you secured metal at paper prices that no longer reflect physical reality. The question now isn't whether silver prices are going higher. The structural deficit makes that inevitable. The question is whether you understand the magnitude of what is coming and whether you've positioned yourself before the broader market figures it out. JP Morgan clearly understood the magnitude, which is why they spent 8 years accumulating 750 million ounces and accepted prison sentences for their traders as the cost of completing that accumulation. They didn't build the largest private silver stockpile in history expecting modest returns. According to data from the World Gold Council and precious metals research firms, the silver market is approximately $1.4 trillion in total above-ground stocks at current prices. But only about 2 billion ounces of that exists in investable form, which is roughly $154 billion at $77 per ounce. Compare that to the gold market, which has approximately $14 trillion in above-ground investable stocks. Silver is roughly 1% the size of the gold investment market by value. Now think about what happens if even a small fraction of capital that's currently in gold, stocks, bonds, or real estate decides they need exposure to physical silver because they've seen the supply crisis developing. If just 1% of the global gold market, which equals $140 billion, tried to move into physical silver, that would be nearly equal to the entire investable silver market. There isn't enough physical silver available to absorb that kind of monetary demand on top of the existing structural deficit from industrial consumption. Prices would need to rise dramatically just to ration that investment demand down to available supply. And that's before accounting for the fact that JP Morgan allegedly already owns 750 million of the 2 billion ounces in investable form, which means they've effectively removed 37.5% of investable supply from the market. The COMEX data we're seeing in early February 2026 suggests we're in the final innings of this setup. When registered inventory drops 26% in a single week, when physical premiums run 50 to 80% above paper prices, when the March contract shows more open interest than available inventory with first notice day just weeks away, you're not looking at a market that has months or years to resolve gradually. You're looking at a market that could break in the next 30 to 90 days if delivery pressure continues at the pace we've just witnessed. JP Morgan paid $20 million in 2020 to settle their manipulation charges. They paid another price in the form of prison sentences for 2 traders who carried out the scheme. They accepted those costs because they knew what was coming. They knew that China would eventually restrict exports to secure strategic materials for domestic technology production. They knew that solar and EV adoption would accelerate industrial demand beyond mine production capacity. They knew that years of systematic price suppression would create the opportunity to accumulate a position so large that when the inevitable shortage arrived, they'd be sitting on the only major available stockpile in the Western world. The manipulation is over. The spoofing has stopped. The accumulation phase is complete. JP Morgan has flipped from short to long. China has cut off exports. COMEX inventories are collapsing. Industrial demand is exceeding mine supply. Physical premiums are decoupling from paper prices. Every single element that needs to be in place for a massive short squeeze is now present in the silver market. The only question remaining is whether you recognize these patterns before the price reflects them, or whether you'll be part of the wealth transfer going the other direction. That $920 million fine that the media called a punishment, it was proof that the largest bank in America was willing to break the law for 8 years to position themselves for what's coming. They didn't manipulate silver markets, accumulate 750 million ounces, flip their positioning right before a supply crisis, and put their traders in prison for modest gains. They did it because they saw the mathematical inevitability of what happens when industrial demand structurally exceeds inelastic supply while inventories collapse and the world's largest exporter restricts trade. The curtain has been pulled back. The playbook is visible. The positioning is complete. The only question is, are you positioned on the same side of this trade as the bank that saw it coming years ago and paid $920 million for the privilege of setting it up?